Ladies and gentlemen, good day and welcome to the Vijaya Diagnostic Center Limited Q2 FY22 earnings conference call. As a reminder, all participants' lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note this conference is being recorded. I now hand the conference over to Mr. Krishna Kiran from Investor Relations. Thank you, and over to you, sir.
Thank you, Vikram. Good afternoon and a warm welcome to our second quarter FY22 earnings conference call. I am Krishna Kiran from Vijaya Diagnostic Center Investor Relations. We hope you have received Q2 FY22 financials and the press release that were sent out yesterday. With me, we have our senior management team represented by Ms. Suprita Reddy, Chief Executive Officer, Mr. Sunil Chandra, Executive Director, Mr. Narasimha Raju, Chief Financial Officer, and Mr. Siva, Head of Strategy. We will begin the call with comments from the management team, followed by an interactive Q&A session. This call may contain forward-looking statements about the company, which are based on beliefs, opinions, and expectations of the company as on date of this call. These statements are not guarantee of future performance and involve risks and uncertainties that are difficult to predict. And with that, I will hand over the call to Ms. Suprita Reddy for the highlights. Over to you, ma'am.
Thank you, Krishna. Good afternoon, everyone. I hope all of you are safe and healthy. I welcome you to our first investor call after the IPO and our company's listing on the National Stock Exchange and the Bombay Stock Exchange on the 14th of September 2021. This being our very first investor call, I would like to start with a brief overview of our company and then hand it over to Sunil, who will elaborate on the company's strategy and financial performance. Vijaya Diagnostic Center was founded in 1981 by Dr. Surendra Reddy, our Executive Chairman, with a vision to provide comprehensive diagnostic services of the highest quality under one roof at affordable prices. Over the years, we have grown steadily by adopting a customer-centric approach. Vijaya is one of the largest and the fastest growing diagnostic chains in southern India. As on 30th September, the company has a footprint of 85 centers and 11 reference labs spread across 14 cities and towns in Telangana, Andhra Pradesh, NCR, and Kolkata. We serve around 10,000 customers a day and perform around 9 million tests per year. All our labs are NABL accredited and 3 of our centers have NABH accreditation. We follow quality standards of the highest order. Ours was the second lab in India to have been accredited by NABL back in the 90s itself. Vijaya has been one amongst the first in the country to introduce new technologies and high-end specialty tests. We have an expert team comprising over 200 doctors with specialized and super specialized expertise and over 1,000 technical staff who bring with them years of experience and skill, enabling us to always offer the best and the most wholesome customer experience. We are one of the largest customer-facing businesses in the country today. Our customer-centric approach and the brand's repute for high-quality diagnostic services enabled higher brand recall in our core geographies. As a result, our business and revenue are majorly driven by individual customers. More than 90% of our revenue is generated through direct walk-ins. Today, our growth far supersedes the industry trend. Our EBITDA margins of over 40% is a record breaker, and we always operate with negative working capital. Vijaya operates on highly efficient and robust hub-and-spoke model, wherein a full-fledged center called a hub is established initially. Once operations stabilize, smaller centers termed as spokes are added around it. Our service offerings range from basic pathology to high-end radiology. Being in the customer-facing business space, our philosophy has always been customer first. We immensely value and appreciate the contribution of our employees. Some of them have been with us since inception. Vijaya has been recognized and rewarded time and again for superior quality services, the most prominent ones being one of the best healthcare brands, leading diagnostic chains, and many more. During the first half of the current year, we have opened 5 centers. A strong performance demonstrates the inherent strength of our unique business model. Though revenue from COVID-based investigations has declined during the quarter, we are extremely glad to declare that in the current quarter, there has been a strong year-on-year growth of 22% through non-COVID investigations. I now hand over to Mr. Narasimha Raju, our CFO, who will discuss the company's financial performance.
Thank you, madam. A warm welcome to everyone on the call. I will now share our performance for first half of the current fiscal year. During H1 FY22, the number of footfalls have increased by 70% year-on-year from 1.06 million to 1.81 million. Number of tests up by 62% year-on-year from 2.80 million to 4.55 million. The strong growth in footfalls and tests is also due to low base in the corresponding previous period. Revenue per test stood at 518 rupees and revenue per footfall clocked at 1297 rupees. Consolidated revenue increased by 43% year-on-year from 165 crore in H1 of last financial year to 235 crore in H1 of current financial year. The growth was driven by 56% year-on-year growth in non-COVID business. Non-COVID business increased from 133 crore in H1 of last financial year to 206 crore in H1 of current financial year. COVID business declined by 10% from 32 crore in H1 of last financial year to 29 crore in H1 of current financial year. The contribution from COVID has come down from 20% of revenue in H1 of last financial year to 12% of revenue in H1 of current financial year. Our B2C share in revenue in H1 of current financial year stood at 93%. EBITDA grew by 66% to 108 crore in H1 of current financial year from 65 crore in H1 of last financial year. EBITDA margin stood at healthy percentage of 45.9%, witnessed an increase of 640 basis points over corresponding previous period. The profit after tax, the PAT, increased by 114% year-on-year to 61 crore. The cash and cash equivalent at the end of September 2021 was 229 crore as against 228 crore as at end of March 2021. And during this first half, we have generated cash flow from operations of 84 crore, of which the capex incurred was 46 crore and the capital advances to equipment suppliers like Philips and Siemens for the upcoming branches amounts to around 25 crore. As on 30th September, around 12.7 crore is a receivable from selling shareholders as part of IPO expenses, which were subsequently received. Capex of 46 crore includes 35 crore for acquiring a land in Hyderabad for setting up state-of-the-art facility on our own premises. Return on equity for the current period stood at 28% and pre-cash ROCE stood at 45%. Now I will share the quarterly performance. Number of footfalls for the quarter under review increased by 32% year-on-year from 0.66 million to 0.87 million. Number of tests also up by 35% on year-on-year from 1.75 million to 2.36 million. Number of tests per footfall reached to 2.72, which is higher than 2.69 in the last financial year. Revenue per test stood at 477 and revenue per footfall clocked at 1295. The consolidated revenue stood at 113 crore, which is similar to corresponding previous period. Please note that our non-COVID revenue increased by 22% year-on-year from 85 crore to 104 crore. COVID business declined by 70% from 28 crore in Q2 FY21 to just 8 crore in Q2 FY22. The contribution from COVID has come down from 25% of revenue in last year Q2 to 7.5% of revenue in the current quarter. Again, our B2C sharing in the current quarter stood at 93%. EBITDA came in at 51 crore, which is similar to corresponding previous period. EBITDA margin is healthy at 45.4%, improved by around 10 basis points over corresponding previous period. The PAT increased by 5% to 28 crore, resulting in a PAT margin of 24.6%. Now, I will hand over to Mr. Sunil Chandra Garu, our Executive Director, who will take us through the strategy going forward.
Thank you, Raju. So, I'd like to just quickly take you through the company's future business strategy. And as we had mentioned even during our IPO process, our focus is on expanding our presence in our home markets, our core geographies of Andhra and Telangana. And to achieve this, we plan to expand our footprint by setting up more spokes and hubs around this in the existing as well as new areas of these two states. As Subrita had mentioned, we have opened about 5 centers in the first half of this year, and we are planning to open about 10 centers in the second half of the current financial year. So these will be in cities and towns in the edges, in the home markets as well as adjacent geographies where our brand is recognized and regarded. We already have identified areas where we will be opening new centers in the current financial year as well as even going forward in the upcoming next few years. Also, we have a focus on East India, and as again we had mentioned earlier, Vijaya operates in Kolkata through a hub center by the name of Medinova Diagnostic. It's a subsidiary of Vijaya, and it is a BSE listed company that we have acquired in 2014. So during the pandemic, our efforts under the Vijaya brand name have actually strengthened our presence in West Bengal. We have done a lot of COVID testing and other allied services in that area. And therefore, we want to leverage this goodwill and the brand that we have built in that area by opening up new centers, both in Kolkata as well as in other areas of Bengal and East India. So, again, I think, of course, this is the first results after our IPO. It's a very short period. But as I mentioned, yes, we have already had 5 centers which have opened in the first half of this year, and we have about 10 centers that will be opening in the second half of the current financial year, which will contribute to our growth. And I think the plans going forward are very much in line with what we have mentioned during our IPO roadshows also. We will continue to open more centers in our home market as well as also in the adjacent geographies and Eastern India, which is I think we feel that it is a key area for the company. It's an area of huge opportunity for the company. So we'll be happy to take any questions that people have now.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star followed by 1 on your touchtone phone now. We have a first question from the line of Harith Ahmad from Spark Capital Advisors. Please go ahead.
Yes, good afternoon. Thanks for taking my questions. My first one is on the non-COVID revenues for the quarter. So it appears that we've had a flat quarter on a sequential basis. So given normal pathology testing across the country and even in your geographies was severely disrupted in the first quarter, I was expecting a stronger recovery in the second quarter. So will you be able to give more color on the non-COVID revenues, especially on a sequential basis?
Sure. We considered RT-PCR and COVID antibodies as part of the COVID. So just like the other industry peers, if you consider D-dimer and IL-6 as part of the COVID and COVID allied test, you see a growth of around 12% sequentially from the Q1 to Q2, 12%. And whereas when you compare year on year from last year Q2 to current year Q2, it is 28% is the growth in the non-COVID business.
Okay, that's helpful. And then when you refer to COVID allied testing, does that include a radiology component? Because I believe CT scans and then some of the radiology tests also would have been part of COVID allied. Is that the way to look at it?
No, in fact, that's the reason why we've only considered COVID to be COVID RT-PCR and COVID antibodies. So COVID allied testing, we've only considered D-dimer and IL-6, and nothing apart from those two, and nothing from radiology.
Okay, understood. So yeah, my second question is to understand the profitability profile of our two segments, radiology and pathology, a little better. I understand there's a lot of shared costs, and given these shared costs, you won't be able to give specific margin numbers for the two segments, but just trying to understand if our pathology margins are broadly in line with other larger listed players who are exclusively into pathology almost, and they have their margins at around 25 to 30%. So any benchmarking versus peers or any color around this that you can share will be very helpful.
Yeah. As you rightly told, since it is an integrated service offering, giving both pathology and the radiology service under one roof, okay, there are various common costs. That's the reason why we are not able to bifurcate the margin between these two segments. However, at the gross margin level, okay, definitely the gross margins are higher on radiology front and slightly lower on the pathology front. But when you ask me what is your pathology segment profitability as compared to the other industry peers, as I told you, we can't bifurcate our EBITDA margins of above 40% into these two segments, but I'm quite confident that, okay, considering our B2C share of revenue, you might have noticed that more than 90% of revenue comes from B2C segment, whereas in the other industry peers, okay, B2C segment revenue is not that much more. Considering that one particular parameter, I think we are at par with the industry, or we will be slightly higher than the industry. But we don't have the exact split of these EBITDA margins, but overall company EBITDA margins are above 40%, and in the current quarter, we achieved 45.4% EBITDA margin in the current quarter.
Okay, that's helpful. And then last one, if I may, you mentioned that you added 5 centers in the first half, and you're looking at adding 10 more centers in the second half. So going forward, if I think of FY23 and maybe FY24, do you have any targets in terms of number of centers you'll be adding, or should we think of this number of around 15 centers as the number of centers you'll be adding each year in the medium term?
Sure, Harit. So if you see, even historically, we've been growing at a good rate, around 15 to 16% year on year, and we typically add around 14 to 15 centers with a mix of both hub and spokes. So I think we have clear visibility on that even for the next 2-3 years, and that is what we can expect.
Just one clarification there. When you talk about 5 centers added in the first half, it's a mix of both hub and spokes, or is it just spokes that you're referring to?
It is both hub and spokes. There is one hub, and there are 4 spokes. And we've also upgraded one of our spoke centers to we've upgraded it, and it's now a hub center. So if you actually look at it, there are 5 centers and one upgraded center to a hub.
Okay, understood. Thank you very much. I'll get back to you.
Thank you. Anyone who wishes to ask a question may press star and 1 on your touchtone phone now. Your next question from the line of Ashika Jain from Edelweiss. Please go ahead.
Hi, good day everyone. So my first question is on your capex. So in your opening remarks, you mentioned that you have almost invested 35 crores to purchase the land in Hyderabad for your flagship center. So just wanted to understand your thought process around opening another flagship center in Hyderabad, rather than settling on hub and spoke expansion. Are you seeing some demand uptick or any change in the business environment? Some color on that would be helpful. Thank you.
Sure, Ashika, I will take that. So, in fact, you're right. So, we did take up this property to build a center that would be company-owned, mainly because our model itself is unique and we focus on giving that experience. Being that customer-centric model and most of the business coming in through walk-ins, if you look at the need of our business, the chunk of the business happens during the first half of the day. So, all the footfalls are concentrated in one area. And because of that, we felt that we were not maybe give the same kind of experience because of the crowding happening in the near future. For that reason, when we found something with close proximity to our flagship center, we went ahead and took it, also because the company will own a center of its own, and we will also be able to maintain and maybe better the experience itself, and also add a few more modalities in that area itself. And that was the reason why we acquired this land.
Okay, sure, that's helpful. And just follow up on that. So how should we see the capex funded in H2, and also can you guide on the capex plans for the next 2 years?
Yeah, Ashita, as we mentioned earlier, okay, the plan is to open at least like a 15 centers each year. In the current year, we already opened 5 centers and 10 more we're planning to open. So the capex requirement for 15 centers with a combination of hub and spoke, like 4 hubs and 11 spokes, it comes to approximately like a 70 to 75 crore. So each year we are planning to open these 15 centers. The capex requirement will be year on year, it will be 75 crore rupees each, approximately.
Okay, thank you. And just if I can squeeze in the last one. So just wanted to understand your outlook on your EBITDA margin. So even in this quarter where had lesser COVID contribution, your EBITDA margins are well above 45% plus. Now, is this a sustainable run rate in your view, or how should we see it going forward?
So we are fairly confident on above 42% EBITDA margins going forward, Ashita. In the current quarter, we achieved 45.4%, but we are fairly confident in the long term, okay, above 42% EBITDA margins.
Sure. Thank you. That's helpful. Thank you.
Thank you. We have next question from the line of Astha Jain from Hem Securities. Please go ahead.
Hello. Yeah, am I audible?
Yes, you are. Please go ahead.
Yes. So the question is regarding, like, if we see the industry result, or where it is although it is not a strict comparable, but still the quarterly growth which the peers have shown, and we are not able to, we have just posted flat growth. So just wanted to know the reason behind it, and what gives you so much confidence that you will be able to maintain the growth going forward. So these are the 2 questions from my side.
So if you look at our quarter-on-quarter growth from last year Q2 to current year Q2, by considering D-dimer and IL-6 as part of to 28% year-on-year growth we have shown in our non-COVID business. And also sequentially, as I already highlighted, it's like a 12% growth from Q1 to Q2. And in the past, as you know, we have grown at a CAGR of 15 to 16%, and we are fairly confident that on an annual basis, we'll be growing at 15 to 16% comfortably, because we also have the organic plan of setting up 15 centers. And in case if we do any good M&A acquisition, that will add to this 15 to 16% CAGR growth that we are projecting.
Because what happened, I think this is the industry-wide phenomena that non-COVID revenues have shown a jump to all competitors or peers, I should say. But looking after that also, the results were like on a very much flat note. So that's why we have this thing that what went not in the favor of a company, or a company cannot post the growth figures as the others have shown.
So the other way you see, so just to add to what Raju just said, so last year Q1 and Q2 were a little bit unique in our geography. As we said, like, we got the COVID testing permission from the state government only in the end of Q1. So there was a lot of rush for COVID testing in Q2. So Q1 was very low last year, and there was a little bit of bulge in Q2. That was the reason these 2 quarters are not directly comparable, when you compare with the other peers. So okay. Q1, the base is lower. Q2, the base is a little bit higher.
Okay.
So if you see H1 versus H1, then we'll be in a comfortable position.
Ma'am, I'm sorry to interrupt. We're not able to hear you.
Thank you so much.
Thank you. Ladies and gentlemen, if you wish to ask a question, please press star followed by 1 on your touchtone phone now. We have next question from the line of Praveen Sahai from Edelweiss Financial Services. Please go ahead. Mr. Praveen Saha, your line is unmuted, sir. Please go and ask your question.
Yeah. Thank you. Thank you for taking my question. My first question is related to the revenue per test. That there I can fairly understand because of a COVID that number is going down. So is it like we can assume this will go back to the pre-COVID level of around 420, 428 rupees? What your sense is for the way forward?
So the current run rate of average revenue per non-COVID test is around 470. So we don't expect that to be at some 420 or 430, but comfortably we will be around 470 to 475.
So this number is excluding your, the some allied test which you are referring to for the growth, 12% of sequentially or 28% of YOI growth. The X of that number you are saying this realization is a 470.
Yes, correct.
Okay, thank you. And the next question is related to the lease liability. So I can see that from the March to September there is some 21% of increase in the lease liability. So what is that for?
So this relates to the India's leases accounting for the branches that we have taken on lease. As you know, in the current 6 months, we opened 5 new centers which are taken on lease, the premises. And also we have signed a few more lease agreements for the upcoming branches. So because of these new leases that are taken, the lease liability, the India's lease liability has increased from 136 crore to 165 crore between March to September.
So if I look at for the future also you had some accounted, because if I look at the rate for the 80 centers 136 crore and then 85 centers for 166 crore. So rate if I look at it's on the higher side. If I added 5 only, then it's looking very high for a 5 centers rate.
We should not look at it proportionately because, so on the day one when you're accounting it, you will consider the entire 15 years of the lease expense. You will consider and do it. So gradually it will keep coming down. So now it's like many leases got completed for 10 years. So the number that you're currently looking 136 is not comparable to calculate proportionally for 5 leases.
Got it. Now the last question is related to the expansion plan. As you had already highlighted, that's the 15 centers, hub and spoke mix of that you are going to do. Is there any plan for some inorganic expansion in that? And how is the mix for you are largely in the Andhra and the Telangana, and there is also presence in the east. How is the mix of geography the way forward?
So basically, as I think we mentioned, our focus is on, of course, our core home market as well as east, and especially in the east. We have already started working on identifying locations for our own centers, our organic strategy. And in addition to this, of course, we are opening centers, as you know, 15 centers here in our home markets, and east also we are now working on. But we are quite keen to look at any kind of M&A or inorganic opportunities. And as I think you and most of the other people on the call know, there has been some amount of M&A happening in our industry. So we are also quite actively looking at any opportunities that come our way, and hopefully if something attractive, which also the valuation is is viable for us, then we will definitely be keen to acquire, and that will be inorganic growth.
Okay, so this 15 center is for a home market only.
15 centers are not just home markets, they're also adjacent geographies, and some also might come up in the east. We wouldn't have exact details right now, but it will be a mix of all.
Thank you and all the best.
Thank you.
Thank you.
Thank you. To ask a question, ladies and gentlemen, you may press star followed by 1 on your touchtone phone now. We have next question from the line of Cinderella Carvalho from Centrum Broking Limited. Please go ahead.
Thanks for the opportunity. Madam, if you can help us understand how is the current scenario in terms of testing going on, how is the market behaving?
Excuse me, we're not able to hear you too well.
Ma'am, I'm sorry to interrupt. Yes.
Is this any
very
better?
clearly audible. Yes, you may please come to a better network area and speak through your handset. Thank you.
Yes, thank you.
I'm sorry, we're not able to hear you, ma'am.
Okay, I'll join back.
Yes, please join back the queue. Thank you. Thank you. To ask a question, participants may press star 1. We have the next question from the line of Nitin Raheja from Julius Baer. Please go ahead.
Hi Sunil, hi Suprita. Very good afternoon to both of you, and congratulations on the results.
Hi Nitin. Good afternoon.
Hi. So, I just wanted to get a little broader sense from you in terms of, we've seen a lot of action happening in the industry in terms of the whole inorganic acquisitions that have been taking place. And it's basically been the so-called players who are termed as national players who have been doing that. What do you think is driving this broader trend that the industry is seeing at one level? And for someone like you who is a very strong or building a strong regional franchise, how does that position you with respect to this?
So there's two parts to that question, Nitin. So one is, I think, because of the business, especially if you look at us, we are a strong B2C kind of a company. We are a brand in our home market. So when we want to go to a new geography, obviously, if we are able to find a good fit, a good opportunity to acquire somebody with a similar kind of a brand value system, then it does help us in terms of growing, right? Because they've also put in that effort into building a brand. So that's the reason for anybody, whether it's us or our peers. If you want to enter a new market, an acquisition of the right kind of partner will make it easier to ramp up in that market. That's the logic there. Unfortunately, because our business, even today, 18-19% is only organized. It's a largely unorganized, fragmented kind of business. There's not too many, I would say, players who have built good businesses of some size or scale which can be acquired. So that scarcity as well as the need to grow has resulted in sometimes the valuations becoming a little stretched. So I think we are very keen to acquire if we find some suitable opportunity in the markets of interest. But we'll have to balance that with I would say the valuations and whether those valuations are attractive for our company, for our shareholders, because paying a unreasonable valuation will I think not really serve the interest of the company.
Sunil, my question also was that why is this flurry of activity happening at this stage or now? Is it something that is being led by any sort of change coming about in the industry and business, led by technology or something, which is causing this sudden spurt in activity taking place?
No, I think technology is anyway there, and I think everybody's adopting digital and technology. If you were to look at it, I think from the recent couple of 2-3 transactions that have happened, it's more of acquiring new markets. I think some of our peers have acquired companies which give them a new presence in a different region, and that's I think that's kind of what everybody wants, right? They don't want to be seen as just one region, so they want to expand to other regions, and that's maybe one of the reasons why they've done these acquisitions.
Is there something to it that if you really see even today, the so-called national players, as we club them, were actually very strong regionally? So, for example, Dr. Lal was very strong in the north, or Metropolis was very strong in the west, and but the business had so far grown in a way and manner where you had very strong regional players actually who were, taking over initially local, regional, small unorganized players. And now, I mean, suddenly, is there something about this business which causes it to be so strong regionally? And now things are changing where people want to think nationally and so on and so forth?
I can't comment about the industry, but yeah, if you look at our model, we are very B2C focused. And what we have always believed in is that when you have patients who walk into our centers, then that kind of builds a sustainability in terms of, these patients being our customers for the long term. And also the profitability is higher compared to if you do a B2B model. So that is really how we have built our business model. And obviously, yes, it's I wouldn't say regional, but when you go to a new geography, it takes a little time to build that brand. So you can't just say I'll be national, and open centers all over the country and expect to build a brand overnight. So I think our concentration is on building a deep focus on the markets that we are currently present in. And we want to do this by putting a density of centers and make sure we don't dilute our profitability also.
And also, COVID itself, Nitin, has created a lot of awareness among people and the expectations have risen. So I think if you look at it, we're uniquely placed in terms of that B2C, and the customers was always coming to our centers. And if you look at largely the unorganized sector, when they do visit those centers, the entire experience, the technology, the TAT, the feel to it, all these make a difference. And I think that's changing a bit, and that's also accelerating the growth faster now.
How big will the East be for you? I mean, in a few years from now?
How big will the East be for you?
I think the plan, obviously, over the next 4 years is to kind of build it into a second alternate market. And if you look at the broader strategy, maybe we go to about, right now we are at about 80-85 centers. If we go to about 140-150 centers, I think probably about 15% or so should be East. I mean, it's not an exact number, but that's what we are hoping that it will get to.
Great. Thank you. Thank you, guys. All the best.
Thank you.
Thank you. To ask a question, participants may press star followed by 1 on their touchtone phone now. We have next question from the line of Harshit Dhood from Premji Invest. Please go ahead.
Hi, this is Harshit here from Premji Invest. Hey, thanks and congratulations for a good quarter, ma'am. So, Sunil, 2 questions specifically. So, one is on the cost of per center of the new center specifically. So, I think our broader capex of around 75 crore for opening up 5 centers. I want to understand, did the center were more on hub side and much less on spokes, and going forward it's going to be more spokes because per center cost looks a bit high. And the second one is more with respect to the revenue growth itself. So I think as you pointed out that 2Q last year was a aberration given the high amount of D-dimer extra. But in general, when we look at from pre-COVID level, what is your sense of the recovery rate in general for the non-COVID part?
Yeah. Harshit, I will take up the capex part of it. Okay. Yeah. For the current 6 months, okay, you might have seen 70 plus crore capex, the cash outflow, out of which the actual capex for the first 6 months is approximately 46 crore, and the balance was almost like a 25 crore was on account of CWAP and the capital advances that we gave it to Philips and Siemens for the upcoming branches, which you will see in the next 6 months, because you need to give this advance so that, okay, at right time you will be able to get the equipment and then you will be able to start the center as per the planned scheduled dates. And out of the 46 crore, 35 crore was towards the acquisition of the land for the state-of-the-art facility that we explained, and the balance was 11 crore capex. That's it.
And Harshit, also, normally there is not so much of capex paid in advance because of COVID and import restrictions and a lot of other factors. we had to place orders normally 6 to 7 months prior because there's acute shortage of equipment coming into the country itself.
Got it, ma'am. Got it. Sure. And the other one is on the general revenue part.
Yeah, you also asked us about the recovery rate. So we would look at the recovery rate to be around 85 to 90% approximately.
Okay. This is even today, because so there is room for the entire non-COVID business to get to fully recover.
Yes, absolutely.
Yes, absolutely.
There is.
Okay, got it. Perfect. Thanks a lot.
Thank you.
Thank you. We have next question from the line of Shailesh Kanani, an investor. Please go ahead.
Thanks for the opportunity. My question has been answered. Thank you.
Thank you.
Thank you. To ask a question, please press star 1. We have next question from the line of Praveen Sahai from Edelweiss Financial Services. Please go ahead.
Yeah, thank you for taking follow-up questions. Just to follow up on the last query of that's related to the capex. As you mentioned, that 46 crore for a first half for a first center, that looks little higher than what you are guiding for 75 crore 15 centers. So is it because of a hub you have opened, that's why, or how is it?
No, it also includes, as we mentioned, Praveen, there is also an upgradation of the existing center as well, apart from these 5 centers. Okay, so that's the reason why the overall capex for the 6 months is just 11 crore, as against for the 15 centers we budgeted 70 to 75 crore, but we spent only 11 crores towards these 5 centers, and also 1 upgradation plus few plant and machinery capex at the existing centers.
Okay. Next question is related to the centers which you are running or you are opening right now. How much is the capability for the test to handle? So if I look at your historical last 3 years numbers, the test per center, which is continuously dropping. So is it because you are more including spoke? Is it because of that, or how to look at this number?
Sorry, Praveen, did not understand that because...
You said we are dropping. I don't think so.
Yeah, so test per center. So basically in FY19 you have a 61 centers, then 73, then 80. And if I look at your total number of a test performed in a year, it's a test per center. If I look at, calculate, it's a dropping. So that's why I'm asking, like, is it because of spoke centers you are increasing higher number, or how to look at actually? Or how much is the capability for the test per center for your center?
There are 2 things to this. One is the 5 centers that we've opened during the current year were in the months of August and September. Due to COVID second wave, we could not open in Q1, so that they were recently added. The other thing is, if you see even last year, so we opened 7 centers, out of which again majority of the centers are opened in the last 2 quarters after COVID first wave.
Okay.
So one thing, they have not come to the full potential, so that is the reason, because the number of centers have added, but the capacity is yet to be built. So you see that numbers dropping.
And also it's better to look at footfalls, Praveen, because if you look at somebody adding more spoke, the number of tests may be lower in a spoke than a hub, but your EBITDA margins on a spoke center are higher than in a hub. So I think.
Okay.
And also to add to that, Praveen, even though we said that at the previous question somebody had asked, if you look at Q1 to Q2 also, basically our average tests have increased.
Right, you are right. Yeah.
Your non-COVID business is increasing, gradually normalcy is coming in, and average tests are also per footfall increasing.
Great. Thank you for such a great explanation. Thank you.
Thank you. A reminder to participants, if you wish to ask a question, please press star followed by 1 on your touchtone phone now. We have next question from the line of Anuj Suneja from ICICI Prudential. Please go ahead.
Hi, everyone. So my question is regarding the Gurgaon center that was opened up. What are the future plans for that, and what is the current situation for the center?
Good afternoon, Anuj. So the Gurgaon center, like we mentioned earlier, was actually opened up a few years back. This was a model that we tried and tested to build only to do more of corporate work, being in that particular region. So if you look at all other geographies that we've gone to, we've gone in with a large hub center, and after the hub stabilizes, we add on the spokes to it. But whereas in the Gurgaon center, it is only a center that focuses on health packages, corporate packages, and wellness. So since we did that and it's been doing decently well for corporate and wellness business, we've left it at one center rather than growing in that geography, because we see a lot more growth happening in our home centers and east. So we've decided to basically focus on this area and not do anything more in the Gurgaon as of now.
Okay. So another follow-up on this, is that center like pathology heavy? Because
that is absolutely pathology heavy, and when we say imaging, it's morely into corporate wellness, like your 2D echoes and TMTs and screening testing. That's all. It does not even have high-end radiology in it.
Could you give a percentage in terms of what kind of revenue is coming from there?
1 second, I think I'll ask Raju to take that.
Yes.
So approximately 0.5%. 0.5%, Anuj.
Just 0.5%. Okay. Perfectly fine. Thank you. Thanks a lot.
Thank you. As there are no further questions from the participant, I'd now like to hand the conference over to Ms. Suprita Reddy for closing comments. Over to you, ma'am.
Thank you. To sum up, we believe we've built a very trusted, high quality and reliable brand of choice over the last 4 decades. Thank you once again for taking out time to be part of this discussion. For any further information, we request you to get in touch with Krishna or our external investor relation advisors, Orient Capital, and they would be happy to help you. Thank you once again.
Thank you, ma'am. Thank you to the members of management. Ladies and gentlemen, on behalf of Vijaya Diagnostic Center Limited, that concludes this conference call. Thank you for joining with us, and you may now disconnect your lines.